Hello and welcome back to the channel. In this video, I'll be exploring whether Berlin is the most underrated real estate market in the world. In this video, I'll break down the key factors driving Berlin's sustainable property price growth and explain how, as an investor, achieving a 4x return or even 10x in some cases over a 10-year period is very achievable in this often overlooked market. But first, allow me to introduce myself. I'm Niall. I'm an investment advisor over here in the UAE. I work with high net worth investors globally. I specialize in constructing tailored portfolios that prioritize growth, tax efficiency, and global mobility. Many of my clients are seasoned DIY investors who collaborate with me because I bring fresh investment ideas to the table. And one of those ideas is real estate in Berlin. And it's fascinating because almost every investor I work with has some exposure to real estate, whether that's a property in the UK, Southern Europe, the Far East, the States, or the hot market of the UAE, which is where I reside. But no one ever mentions Berlin, and if they do so, it's rarely. Berlin could do with a PR team because based on its investment profile, in my opinion, it deserves far more attention than it gets. I have five reasons why it deserves to get a lot more attention. Number one is the great rental occupancy rates. It's the highest in the world. Number two, macro and demographic factors. Number three, the tech boom. Four, consistent price growth. And five, investment-friendly nature of the market, including the ease of getting a mortgage alongside the tax incentives that they have. But first off, let me start with reason one. Berlin has had one of the highest rental occupancy rates in the world, with a less than 1% vacancy rate annually. Germany is historically a nation of renters, meaning demand for housing remains evergreen. As an investor, you won't need to worry about your property ever sitting empty. It's a reliable, yield-generating market with consistent tenant demand. The second reason are the macro and demographic factors. Berlin is the largest capital in the EU by population, and its population continues to grow steadily. On the other side, the housing supply is failing to keep up with the pace. This imbalance creates an upward pressure on both the rents and the property prices. And when you compare Berlin's price per square meter with other major European cities, it's clear to see how undervalued it is. I mean, London is currently 18,000 per square meter. Paris is hovering around 12,500. And then you have Berlin that comes in way below at around 8,200 per square meter. And even within Germany itself, Berlin is undervalued compared to cities like Munich, Frankfurt, or Stuttgart. The third reason is the tech boom. So over the last decade, Berlin has become a magnet for tech giants like Amazon, Google, and Microsoft. What you see is when companies like this set up base there, it typically attracts the tenant you want, which is young professionals within the city. All these factors have contributed to the annual 8.5% growth over the past decade. Now, while this might seem modest compared to hotspots like Dubai, which is absolutely booming where I live, Berlin stands out for its stability. It's rare to see negative years in Berlin's real estate market, making it a low volatility, long-term growth asset within a portfolio. Alongside that, there are some attractive financing options. So mortgages, you can get that on a 10-year basis below 4%. You can get loan to value ratios of up to 60%. So if we use an example and base it off the 8.5% per year growth that we've seen over the last decade, and let's assume the rental yield covers your mortgages and other costs, a 60% LTV mortgage would generate an annualized return of 17% or a 4x return over the 10 years. Now, that is why I think it's a phenomenal asset class. Typically, if you're seeking a double-digit return, you have to be prepared for significant drawdowns on the way. So a close example is the Nasdaq. Over the last 10 years, that also had an annualized return of 17%. But the worst year in that case for the Nasdaq was 32%. Now, comparing that with Berlin, the worst year in recent years was just a 6% decline. So you're getting just as attractive returns, but much less volatility. And at the start of the video, I mentioned the 10x potential. That's more relevant for those who are Swiss, German, and Austrian. You can leverage up to 90%, which pushes those potential returns even higher, up to 10x over a decade. So alongside alongside the mortgage accessibility, making Berlin's market investor friendly, also you have the tax efficiency of the real estate market over there. So providing you hold the property for 10 years or more, capital gains tax is not an issue, which means you get to keep all of your profits without having to split that with the government. That ties in quite nicely with how I was planning to wrap up this video, by just asking the question, where does Berlin fit into the global property investment market? Because as we know, it doesn't get too much attention. I was doing my research just before this video, and me just typing in the Berlin market, there aren't many videos like that out there. But if you were to type in the UK, the US, or the UAE property market, there's so much out there in terms of assessment. So at the moment, the Berlin property market's under the radar, but I think it's going to get a lot more attention for several reasons, which I've covered in this video. But one of the key reasons is everybody has their own appetite to risk. So if you're somebody who is an aggressive investor, you can tolerate high volatility, you can ride out cycles, then Berlin might not be for you, because you might be seeking even higher returns than what Berlin has to offer, and you might choose a real estate market such as the UAE. But if you're somebody that wants a bit more of a stable and predictable return, then I don't think there's any market that's matched like Berlin when it comes to producing such an attractive return in comparison to the maturity, without the impact of tax. So that's why I think that a lot of the capital that we would have traditionally have seen go into the UK property market, some of it, I'm not saying a majority of it, but some of it might start getting diverted towards the Berlin property market, purely because they're so much more competitive with the tax incentives, which ultimately could be a catalyst for the long-term growth on top of the 8.5% we've seen in the previous decade. So that's it from me. I was planning on wrapping it up a little bit more succinctly, but I hope this serves as somewhat of a good overview. One thing I didn't mention in the video were the specific property investments available. If you'd like to understand what is out there, do not hesitate to drop me a line. We can run through investment projections alongside cash flows. And just finally, if you found this video useful, if you found it informative, please do consider liking and subscribing for more videos like this, where I'll be covering an array of alternative investments, talk a little bit about tax planning, and also provide the latest on the citizenship and residency by investment market. Thank you very much.